Hi, everyone. Paul Krugman again, and talking again with Claudia Sahm, who's one of our one of my real go-tos and tremendously influential voice on macroeconomics. I've been looking at the real-time Sahm rule series on Fred, which is where those blue background charts on my Substack come from, and Claudia is our Fed expert, or a Fed expert, one of my favorites. And so, hi, Claudia. I thought we would talk for a bit about what's been a pretty eventful week, obviously on many fronts, but certainly on the Fed area. So,
Yep. No, I'm happy to be back. Happy to have this conversation. Sad that we are having the conversation, that it's necessary, but it's important to kind of unpack it and see what this possibly could mean.
so before we get into criminal investigation of Jerome Powell and all of that, just there's also there's the state of the economy is kind of interesting, and that's like my mother had a recipe that failed. My father would say it was interesting, but anyway, the state of the economy is interesting. What depending on which data you look at, I mean, there are different conclusions or different stories that people tell. So, what do you think is going on with the labor market? I mean, since we could have that conversation.
Well, yeah. So first, I'll start with what I don't think is happening. Right. I don't see a recessionary dynamic in the labor market. But that actually is a pretty strong statement given the fact that we saw job creation really fall off a cliff last year. Frankly, it had been slowing for some time. So this is not just about last year, but job creation is very low in the United States. And we've seen the unemployment rate move higher. So the jobs aren't keeping up with the people who are out there looking for work. But this doesn't look like our typical business cycle. So the unemployment rate drifted up last year, but it drifted up the year before as well. We are a full percentage point off the lowest point of the unemployment rate in this cycle, which was about close to 3.5%. That, you look back all the way in the post-World War II period, that has never happened. We've never had that much of an increase in the unemployment rate and not gone into a recession. But this is very different. It's been very gradual. It's not really picked up and kind of gone from a slow increase to a really rapid increase that would be normal. So that it is puzzling. And at the same time, this past year, we've seen economic activity continue to expand. Yeah, those GDP numbers, they might be overstated or kind of overstate the case of how much strength there is in consumer demand and business investment, but they look pretty good. So you've got this, you have a really unusual set of circumstances, unusual set of signals from the economy. And, at a moment like that, you ought to be everyone at the Fed, totally focused on how do we interpret the economics, what's the right interest rate, and there could be policy responses that go way beyond the Fed or tax cuts. I mean, I'm very concerned about what's happening in the labor market. It's hurting people coming in, young people looking for jobs, people on the margins looking for, there's some problems here. But we need to really focus on the economics of it and unpacking it. We don't have the usual go-tos because it doesn't look like historical periods. And then we have a moment where politics just floods in the conversation.
I want to talk about the politics in a minute, but for what it's worth, that real-time Sahm rule indicator I think let's not go through what the indicator is again, but 0.5 was your criterion. It's 0.35 now, which is kind of, a little bit worrisome. But on the one side, it doesn't feel like that, or it doesn't look like you say a recessionary dynamic. On the other hand, there's this weird extreme. Apparently, it's extremely difficult to get a job. So if you have a job, we're not having mass layoffs, as you were saying, if young people, anyone who, people do get laid off one way or another still, and even if it's not en masse, and then it's really hard to find a new job. There's a lot of debate about what's going on there.
Yeah, and I think this has been a real lesson. The problem in the labor market right now is a very low rate of hiring. a problem is not layoffs. And often we think like, oh, layoffs, that's the big problem. That's the recession. That's what we would get agitated. And so you say, oh, well, there's been layoff announcements, but we're not actually seeing people losing their job. Jobless claims are, not really up that much. So, everything's okay. Right. Like that there's a, kind of don't get as worried about this. But in fact, a low hiring rate can be very problematic because it over time, you just, as new workers come in, people who finish their education, whether it's high school, college, other training, they really struggle to find jobs, right? And so their unemployment and their underemployment rises. And that can be a big problem, not like in kind of a business cycle recession problem, but I mean, not bringing people in at their full potential like that we could pay
Right.
for over a long period of time. And it is hurting, groups on the margins of the labor market. We've seen the Black unemployment rate really move up in the past year. So but it's not about the layoffs. It's about this low level of hiring. And I think, again, back to what's happening in the broader economy, it's kind of puzzling.
Yes.
It's not that businesses don't have the customers. It's not that they aren't making the profits. They're just not hiring. And there could be a lot of explanations for it, but it's an unusual problem. But just the fact that layoffs aren't happening or they're still very historically low, that's not a coast is clear, right? That is, there's still, I think, an issue for policymakers, but it may not be just as simple as cutting interest rates and, doing tax cuts.
Yeah, it's this kind of freeze. So if you don't move, if you don't have to move in terms of jobs, you're doing okay. But really terrible. It's yeah. I mean, I have been sort of saying, well, extreme policy uncertainty. It's a story. It's probably the simplest story, but we don't really know. As you say, it would be really something to try to figure out.
Yeah, and it could, and there could be an explanation as simple as early in the recovery from the pandemic, we had a very dynamic labor market. We had workers moving jobs, we had labor shortages, we had wage increases, and it may just be the slower hiring now is a reflection of the fact maybe there was some overhiring before. Businesses have hung on to workers, kept workers longer. People get more productive when they're on the job longer. So there may be just this normalization. We had a job full recovery in the beginning, which was unusual for the US in many decades, and we've shifted into a jobless expansion. And it may just be part of the normalization, but it is worrisome, and it's as particularly as it drags on. So then there's the question, is it uncertainty about the political environment? Is it uncertainty about technological changes that might be affecting the workforce? I don't think AI can explain where we are right now in the labor market. We haven't seen the diffusion of those technologies, but it could be holding back businesses from hiring. There's a lot of possibilities here, but it will, it's a slower moving problem than a recession, but that doesn't mean that it isn't a problem and deserves potentially a policy response.
And it's a very policy response, but maybe not monetary policy response, right? It's it's as you said, it's maybe not something that cutting interest rates could solve.
Right. And I mean, the Fed, they took action last year, right? They, cut the federal funds rate by 75 basis points over 3 successive meetings, despite the fact inflation was still elevated. We really didn't make any real progress on inflation last year. Complicated situation, upside risk to inflation, downside risk to employment. And they stepped in, I think it was appropriate, by saying the labor market's not in a bad place right now, but there's a chance that this gets much worse. So we need to act preemptively, take out some insurance. And that was the path the Fed took. I mean, there were disagreements even at the Fed over what's the right thing to do, but they've taken out the insurance. And we're coming into the year where there are some tax cuts to households and businesses coming online, which also ought to give some support to, stabilize the labor market. I think the Fed is going to want to see their actions play out, see what these tax cuts. So we're kind of in a wait and see. I'm cautiously optimistic that we'll see the hiring rate stabilize and move up given this support from the Fed and the tax cuts. But if it's something deeper, this uncertainty or just changes in the labor productivity, I think we're going to learn a lot about the labor market in early this year, and if there are deeper problems, more structural problems, well, then that's not where the Fed has very effective tools, and so then we could,
Yeah,
that's a different kind of
it's funny
conversation.
because normally I'm often people insisting that stuff is structural and can't be fixed by monetary policy. That's been abused so often in the past. But this
Yeah.
actually looks like it. Maybe it doesn't. This does not look like a simple problem that money is too tight.
Yeah, and I mean, the Fed should be in there, right? They should use the tools they have. The federal funds rate, they have plenty of room to cut, right? If they're, and their dual mandate is maximum employment and price stability. If employment is really starting to slide, the Fed should be stepping in. It's just a question of like, we want to solve the problem, right? Like, and if the Fed may not be the solution to the problem, but it doesn't, as you said, it wouldn't excuse them from staying on the sidelines, and they haven't
Right.
stayed on the sidelines. Like they are in the mix. It's just a question of, again, because this is such an unusual dynamic with the labor market and the broader economy, it just raises questions about like what's the right lever to pull. I mean, frankly, we ought to pull a lot of levers, like take uncertainty out of the economy. The work. I mean, I think there's a lot of conversations around AI that could probably benefit the labor market. So that we should be trying lots of different things, because it is, even though the layoffs aren't with us right now, this is a real problem that is going to build over time.
Okay, and so this is a time when you would really want a lot of calm, detailed analysis, and you won't necessarily get it right, but this is why we have professionals at the Fed, and but that's not the way. Not what higher management seems to want. So, what was your reaction? I mean, we know that there's been a lot of hectoring of Powell and the Fed from the White House, but this astonishing criminal investigation. Did you feel about it? I mean, obviously you weren't happy, but
Yeah, I mean, there's a lot to unpack from this week with the Fed. I mean, first, I'm deeply concerned about the ongoing escalation of pressuring the Fed to lower interest rates. I mean, taking out a criminal investigation against the Fed chair, this is a very serious. This is past using words to insult. This is a pressure campaign, and it's one that's being used not just against the Fed, right? So there's a really big issue with the actions that were taken by the Trump administration. I fully support Jay Powell coming out with a public statement, being very clear. I mean, using the words of the renovation, this is a pretext, right? Jay Powell's 2-minute public statement, it was written, video statement, was extraordinary. The Fed tries very hard, and he has stayed out of the politics. Powell has not said the White House is pressuring us to lower interest rates until Sunday. And it was a very clear and direct and brief message, unlike what usually comes out of the Fed, right? This was, and I thought one thing that I really appreciated in his statement, Powell didn't refer to Fed independence or the jargon. He laid it out very clearly what's at stake. Are interest rates going to be decided by evidence and economic conditions, or are they going to be decided by political interference and intimidation, right? Like, this is not about the Fed. And frankly, we've seen other efforts from the White House just in the last week to try to push down interest rates in other places that are very much, the president just saying credit card companies cut rates to 10% just by edict, right? So I think there's, really focusing in on, this is not about the Fed. This is not about, the institution. Like, it's about the economic outcomes that are going to affect people. Because it might sound like to everyday Americans, oh, lower interest rates are great. Like, who wants to pay more in interest, right? Like, that's not, if you're a borrower. I mean, if you're saving, you want interest rates to be higher, but you want experts who can play through, what does this mean, not just on day one when the interest rates are cut, but what does this mean 2 years, 5 years from now in terms of economic outcomes? And I think I really, appreciated Powell for calling out the politics. I mean, calling out the escalation that's been very clear and centering on like what are we really talking about here? Like this is about the economics, the evidence, or about the politics. All fine. There was a big outpouring of support, including from some congressional Republicans who are close to the president. This does not seem like this was a successful campaign. Powell did not back down. He did not resign. He is probably not going anywhere anytime soon. I find that somewhat, this is good for the Fed. But I am deeply concerned that a lot of the outpouring of support, it goes back to, this is Jay Powell. This is an individual who is a lifelong Republican. He has worked in Republican and Democratic administrations. He is the last of the kind of bipartisan Fed members. He was elevated to a governor at the Fed by Obama and then brought to being chair by Trump and renewed in the chair position by Biden. The kind of credentials and support that he has built over decades of his career in Washington, working in politics, also working in private industry, nobody at the Fed has that kind of backing. And so, if Jay Powell had 3 more years left on his chair and the president had 4 months, I'd be like, okay, we're going to get through this. But it's the opposite.
Yeah.
Jay Powell's out in 4 months as chair.
Okay.
And the Fed is in a very precarious position.
I may want to come back a little bit to by the way, just to say, you and I are accustomed to reading Fed speak and know that this is not how central bankers usually talk. In fact, that statement by other central the statement by former Fed chairs and so on in Powell's support was, I think, largely unreadable by normal human beings. But Powell's statement was really crystal clear, which was totally amazing. And so this what tells you in a way just how grave the things are, because there's a reason why central bankers usually avoid being too direct, so as not to rile markets and so on. But what happens? So Trump will replace Powell, and presumably whoever he chooses, and we may want to talk a little bit about those choices, but presumably whoever he chooses will be chosen, at least in the White House belief, that he'll do what they say and cut rates and, just generally. But what actually happens? Because it's not that simple. I mean, the Fed isn't simply run by the diktat of the chair.
Right. So we're at a place where the president is going to make his nomination for Fed chair. This has been a long drawn out, the Fed chair apprentice series. So we don't know who that person is yet. But the president Trump has made a very unusual and I think very problematic statement that he's not putting anyone up unless they are in favor of much lower interest rates. So again, this is not about the evidence, economic conditions. The president's like, I want rates lower. And he's only going to put people in that are committed to getting rates lower. And the problem is, well, there's a lot of problems with that, but this person has to then get through Senate confirmation. I think it was really important that some of the first and very influential members of Congress who stood up for Powell this week, they're ones that are going to they'll be instrumental in getting Trump's nomination for Fed chair in place as Fed chair. And in fact, Senator Tom Tillis, who's on the Senate Banking Committee, said until this, investigation is closed up, he's not advancing any nomination to the Fed, including the chair. So again, Powell's term as Fed chair ends in May. It's problematic. I mean, this is the time where things should be moving. So there could be hurdles in the Senate, but in all likelihood, I mean, I think we should assume that Congress is going to give the president who he wants as Fed chair, right? And so that person comes into place. Now, the Fed chair, it's a leadership position. It is incredibly important. But at the end of the day, the Fed chair has one vote, right? And it is there are 19 Fed officials. 12 of them are voting. Obviously, the Fed chair votes, and a majority, the interest rates, to move interest rates down, you would have to have 7 votes. And so, a Fed chair coming in committed to lower interest rates has to win over other Fed officials to make that happen. And, we already knew coming into this year, there was a lot of disagreement about Fed officials, even with the rate cuts last year that Jay Powell was able to, lead the Fed through because there's economic concerns. I think, you can, there are there's a case that could be built if the data come in to support it that would lower interest rates. And Powell has said, many Fed officials, they expect the next move of the Fed to be a rate cut. They're just waiting for more evidence, in particular that inflation slows. So there is, I do expect the Fed to cut interest rates. I think it will take some time, but that's not what the president wants rates down now and down rapidly. So there's, I think there's been a lot of worries about Trump putting a loyalist in at the Fed, this individual being able to strong arm other members, and they may get an assist from the Supreme Court if the president's allowed to remove Lisa Cook and other members where they can kind of pack the Fed and get the votes. That may be the path we're on. That would be very bad in terms of interest rates because ultra low interest rates are not what the economy needs right now. But I think there's another path that hasn't been discussed as much is that we could have a very weak Fed chair. We could have someone in who is a loyalist to the president, who uses the bully pulpit of the Fed, and the Fed's got a big bully pulpit, to just amplify the White House economic messaging, isn't able to build a consensus, doesn't have the trust of other members, and then can't get interest rates down. Maybe the president gets mad, steps in. The next Fed chair may be the one that actually gets fired. Because who's going to stand up and defend the loyalist Fed chair? Right? He's not Jay Powell. Whoever it is not going to be Jay Powell and have the kind of respect. And the thing is, we don't... Moving interest rates around because of political reasons, that's bad. A weak, ineffective Fed, where the only people who are willing to go work at the Fed are political loyalists, don't have skills, that is an incredibly dangerous situation for us to be in because crises happen. Things happen in the economy. Things happen in financial markets. To have a Fed that isn't top of its game that's a really bad place for us to be. And I think that very weak Fed could be the direction we're heading in right now. And that's it's hard to see how this plays out in a good way unless some of the guardrails of the Fed are strengthened. And that has to come from the Supreme Court, strengthening removal protections, from Congress taking its responsibility of putting independent people at the Fed. But until that happens, I'm not going to be optimistic about this.
Yeah, there's a little people have largely forgotten it, but in early 2000, as the pandemic really, the magnitude became clear, we came very close to a really complete financial meltdown. And basically the Fed poured in liquidity, and would a weak Fed chair weak political pawn, ignoramus, it definitely looks like a possibility, have been able to do that, and that's a good. Yeah, I worry about this.
Right. Well, and there were moments like last year to see disagreement among Fed officials about what's the right thing to do. I found that reassuring. The economy was complicated. Like we were talking about, it's really hard to read the labor market. What is the right thing? What is happening with inflation? So there are moments where disagreement is reassuring and we can handle that. In the moment of a financial crisis, to have disagreement blow up inside of the Fed and seep out of that's a moment where we need forceful action, competent action, and we need the Fed to be helping bring down uncertainty. That is not a moment where you want a Fed in disarray. And that's what we might end up with.
I was interested to hear you say something about who wants to work at the Fed. So maybe I'll get there in a minute. But what was really striking about this thing with the criminal investigations is it's really bad if the president fires officials because he doesn't like which is what happened. We've almost forgotten now. But the head of the Bureau of Labor Statistics, Trump didn't like a jobs number and he fired her. and which didn't actually appear to have changed there, but they're they haven't. The agency hasn't been politicized, at least not yet. But this is more than that. This is saying we will destroy your life. You don't go along with our policy, my policy stuff. I will ruin you, or that's and that has to have a chilling effect throughout government in general, but certainly the Fed. Are you hearing that people are already? Because I'm hearing some rumbles that that the personal situation at the Fed is not great, but I don't know if you're hearing the same stuff.
Right. Well, I think this it goes way beyond the Fed, and I said, like, I don't take a lot of comfort. Some of the situation stabilizing some this week really rested on Jay Powell, right? I talked about he had decades of bipartisan, support. He also is worth tens of millions of dollars, right? Jay Powell is not. I mean, he worked in financial industry for many years. He can. The criminal investigation the Department of Justice is opening. The Fed legal staff cannot represent Jay Powell. He has to hire private counsel and had retained, according to reports, had retained private counsel even before this investigation. I mean, we kind of this is not a total surprise that we were headed in this direction. But for him, this is not, I mean, he has the money to do this. Not every public servant. And he said in his statement, as a public servant, there are times where you need to take a stand. This is true. And I am heartened that he took the stand and he is standing firm. But he has the ability to take that stand that most public officials don't.
Yeah.
And so, they talk about, watch the resignations out of different agencies. I mean, we should be incredibly concerned about resignations out of the Department of Justice.
Oh, yeah.
I mean, there are people, because that's so I think that's where, and that's one of many ways that, threats of lawsuits, I mean, even now, because it's happening, the threat is out there. I mean, people who don't have the ability to represent themselves don't want to take their family through that. They might resign, or they may not even be willing to sign up, right? Because they're not going to be protected. So this is this is a very bad path that we're on, and it goes well beyond the Fed. And so I'm glad that Powell did and was able to take the stand, but not everyone has the ability to do that. And the Fed has more removal protections than practically any other public servants as an independent agency. I mean, Congress foresaw that the Fed would be and over time, there's been attempts to politically influence it. So, you mentioned the commissioner of the Bureau of Labor Statistics is often considered, an independent, kind of run by experts. This is not a place that the politicians hang out, but the Bureau of Labor Statistics, part of the Department of Labor, that's in the administration. That person it's been on tradition and norms that protected that individual from removal, and the president has not respected those at all. And he's, going after people who actually have some legal protections on their jobs, like Powell. So it's a situation that, again, goes well beyond the Fed. And you really do need people who are skilled and competent and trusted in these roles. And they're not going to be welcome.
I mean, particularly if the Fed has a lot of career staff, people who have basically spent their whole lives there and have been dedicated public servants and are not personally wealthy. So Powell, because of a more complex background and private sector and all of that, does have some personal resources. But I would assume most of the people that you really need certainly the people who you really need to make sense of these peculiar goings on in the labor market, for example, don't have a backstop. And so they would be, if we get into the level of this is, the Justice Department will be weaponized against anyone who isn't going along with the president's agenda. My God, it's who would being there, the Fed pays a little bit better than the civil service, but still, who wants to be in that position? Yeah, I mean, do you, this is kind of from left field, but the Fed does more than set interest rates. It also does regulatory supervisory work. Do you have any sense of what's going on with that side?
So early in the Trump so there's this case of keeping politics out of monetary policy, like the tradition of politicians deciding what interest rates are, like that has a support in history, both in the United States and globally. The Fed has taken something of a position that, really protecting itself from political influence on monetary policy. But that case, and I kind of disagree with this, but they've said, well, but the Fed also has a lot of bank supervision and some financial regulations where the Fed isn't standing alone. On monetary policy, the Fed stands alone. Like it is the institution within the U.S. government that is making decisions on monetary policy. But when it comes to bank regulation, it is one of a set of federal institutions. So the Fed works with the FDIC and the Office of Comptroller of the Currency. They kind of split up the banks, and on regulations, they'll work together. So it's less clear, like this is free of the politics influence, because it is all like that's part of the administration. So I guess as an example of this, Michael Barr had been the vice chair in charge of supervision at the Fed. He was put into that position under President Biden, and he stepped down from that position.
Yeah.
Early this year. I mean, his kind of what his vision, and he's continued in his role. He stayed on as a Fed governor. He's continued to give speeches about bank supervision, about financial regulation. But it is clear that his view of where the Fed should be headed, where those areas should be headed, is different from the president's.
Right.
But the Fed didn't take a big stand on Barr is going to stay in place, and instead Barr resigned from the vice chair of supervision. Michelle Bowman, who had been nominated by President Trump in his first term, stepped into that role. She was confirmed by the Senate in that role. So this is a case where, and the direction that the Fed has gone in terms of supervision and its financial regulation is much more consonant with the Trump administration and their views. So, which isn't to say that, it's politicized, but you can see where the Fed is kind of like they're drawing a line with monetary policy, and there's justification of why monetary policy should, not be the purview of politicians, but they haven't brought the regulation into that. And we'll see how that plays out. But that was kind of I think that's the other thing that's so notable about this week, with Powell coming out with this public statement and really calling out the political interference. There are many steps in the first year of the Trump administration where the Fed could have come out and taken a stand, and they didn't. And when Michael Barr, pressure on him, and he stepped down. When Lisa Cook, the president, tried to remove, the Fed didn't take this stand until we got to this place. And that, one can second guess those decisions and, have different opinions about it, but that's, the Fed has kind of treated the supervision as different, but they're still taking the job seriously. I don't want to act like this is just handed over the keys, but you can see you definitely see different approaches and a much lower tolerance for the politics to seep into the monetary policy.
Yeah, it's interesting because supervision is always a funny thing, because on the one hand it is a highly technical. You really can't expect random member of Congress to be able to second guess those kinds of decisions. You really do want professionals. On the other hand, at some level, it is clearly in the political arena. It doesn't. So I don't know how exactly, but would like some more.
Yeah, no, and I think there are. One could make the case, exactly as you said. I mean, and the supervision of banks is so central And frankly, I mean, we have the reason the central bank exists is lender of last resort, stabilizing financial markets. Well, if you have that power, you want to make sure you don't have to use it, which means you oversee the financial system and make sure it doesn't get to that point, right? So the banking system, the financial system, like that's so core to having a central bank, not monetary policy. I mean, like the financial stability really is important. But then, one could make a case that as you said, the bank supervision, maybe that really should just like full-time experts. Maybe it should all be under the FDIC. Like maybe it shouldn't be across agencies. I guess one thing one of my worries is after the financial crisis in 2008, part of Dodd-Frank, it took a lot of the consumer protection responsibilities away from the Fed. Because I think very credibly, there were arguments made that the Fed hadn't lived up to their duties in terms of protecting consumers, that they really focused on, the mortgage fraud and subprime, like it just didn't rise to the attention because the Fed had other things they were focused on. And so you think, oh, let's take this and put it in an agency that's all dedicated, the Consumer Financial Protection Bureau, which I think is a great idea until it gets shut down.
Just a word for listeners. Dodd-Frank is the reform that was put in after the financial crisis, an attempt. It became clear that the existing regulatory structure, which was designed for banks, wasn't adequate for this whole world of shadow banking. And so anyway, so Dodd-Frank took a lot of stuff out of the hands of the Fed. It's and Consumer Financial Protection Bureau. But that CFPB had a lot of legal protection. It was designed to be invulnerable to what has actually happened to it.
And it hasn't proved invulnerable. So then that's where it might make a lot of good economic sense or good procedural sense to have bank supervision outside of the Fed. But the Fed truly has extraordinary protections from interference. It has its own budget. It has removal protections that other agencies don't have. And it's really tied into financial markets in a way that kind of gives it another, I don't think it's the best backstop, but it does give it more protection than other federal agencies. So it's that kind of institutional framework is really important.
A quick anecdote. This group of 30, Paul Volcker used to be the chairman of that group, and he looked at me during some meeting and said, "Krugman, you're looking pretty down. What's wrong?" And I said, I just spent 2 hours listening to a bunch of men in suits talk about bank supervision, which I thought was the most boring, impossible subject. I think it was 2007. A year later, inadequate bank supervision blew up the world. So I was wrong to be so bored, although it is an inherently deeply boring subject. Anyway, but yeah, you're right. I mean, there's always a question here about the Fed has a lot of institutional protection and professionalism, and so it's good to have important stuff under that roof. But if you put too much stuff under that roof, then it's not the Fed anymore, and it's no longer going to be treated specially. So this is a bit hard, but I do worry that in looking at the interest rate decision, we may be looking too narrowly at what's under threat now.
Right, and I think another I don't know, problem that I've seen. There's been a lot of talk about reform of the Fed. Treasury Secretary Bessent has a long list of things that he thinks the Fed has done wrong or could do better. You've seen other Fed chair candidates mention similar things, and I want to be clear: the Fed is not perfect. I think there are big questions about how you have an independent agency where technocrats are making decisions that affect millions of Americans. They're not elected. So then how do you have independence, but then also accountability? How do they report to where should the lines be? Because some decisions should be determined by politicians, right? It's not that you just want, the economists or the lawyers running the world, right? You have a political process. So there's these big questions that have been, since the very beginning of the Fed and will continue about how you could do it better in an institution. Unfortunately, I have a hard time really joining in these let's make the Fed better conversations because they often don't feel like they're motivated in terms of making
Right.
the Fed better. It's like trying to weaken the Fed, discredit the Fed. Like I am not convinced that the president is going to be able to move interest rates down. I think there are a lot of when we talked about a lot of reasons why the Fed just doesn't, pull rates down. I think the president's going to be very effective at weakening the institution, and probably already has. And that's again a big. That's going to be a really big mess to clean up, even if it doesn't blow up in some dramatic market movement. And so that's where, some of these reform discussions aren't about making the Fed better. They're about making the Fed
Yeah.
weaker. And then, and that makes it more vulnerable to, political intimidation.
Yeah. And if you wanted a case for why politicians shouldn't have their direct hand on the dial, it's hard to do better than looking at Trump's recent statements. I mean, I think just the other day he said if the market is up, then we should cut interest rates, because they seem to think of interest rate cuts as a gold star that you get for doing well on a class quiz instead of as a management tool for managing trade-offs. So, what do you think? I mean, how bad? You probably can't answer it, but maybe it's a jumping off point. How bad can it get? I mean, what in terms of how bad it is at the Fed, which I worry about immediately, but because I have friends there. But but how does it get in terms of the macroeconomy?
Right. Well, so we can go back and look at the last time the Fed was under incredible amounts of political pressure. So, and there really are some parallels in terms of where we are in the political calendar as well. So, in his reelection campaign, President Nixon put a lot of pressure on then Fed Chair Arthur Burns. This was someone who he had worked with, had close ties to, and the Fed kept interest rates low in the election year. That was part of, kind of goosing the economy, keeping it going. That's, good for election. That history has been told and we talk about. If you go back and look at that moment, it wasn't just about the Fed keeping interest rates down. There was a big push to get the housing market going, lots of different measures. I mean, the levers that were pulled in the Nixon administration are different than today, right? But it has this spirit. You see, price controls, trying to loosen up credit in the housing market, this big effort to just really run the economy in a way that in the short term was beneficial to people. It looked good. Markets, growth is good. More, housing market is up, stock market's up. And it was, and Nixon was reelected. And we know that Nixon was pulling levers outside of the economy too with the reelection, right? So it fit in a broader, the Fed was one piece in a much bigger puzzle. And we've looked, in the last week, the edicts, the proposals coming out of the president, they go broader than the Fed, right? Cut credit card rates to 10% by next week. Do purchases of mortgage-backed security, they're pulling a lot of different levers to get interest rates down. The efforts to intimidate the Fed haven't been successful up to this point, but they fit within a broader thing. But back to why should anyone even care about this, right? They're going to push interest rates down, try and run the economy hot. Yeah, it politically worked well in terms of the reelection with Nixon, but the economy was a mess on the other side of that. As the price controls came off, as the interest rates and the inflation took off. And so that required to get the inflation under control, which had been building over time. It took some really dramatic efforts from the Volcker Fed in terms of raising interest rates, a deep recession. So it did a lot of damage. And so we've seen this in the US, there are other cases around the world. So you've got this eventually you can end up with higher inflation and you're gonna end up with financial instability. Right.
That's something we aren't really talking about much. But the financial side, I mean, the inflation side is sort of easy. Again, single focus, and there's kind of one number, and there's one interest rate, one inflation rate. But the broader issue of financial stability also, an irresponsible politicized Fed would contribute to that.
Yes. Yeah. And for that, it's really event driven. Right. This doesn't if it's not interfering with the Fed isn't a guarantee that you
Right.
get bad outcomes. And you might not get bad outcomes right away. You might not get them later. We could get lucky in that, productivity really it has risen. It could really set in. It could be disinflationary. Having ultra low interest rates might be the right thing to do by the end of this year, next year. I mean, this is not my base case at all, but like you could have events come together in a way that like pushing interest rates lower doesn't create excess inflation, doesn't create instabilities. We might not have another kind of Silicon Valley bank run type issue. We might not have, credit market problems or whatever. And then it's like, oh, this wasn't such a big deal. And I think for markets, it's kind of like they haven't reacted much to all this because we're not really in a crisis moment. Like we're not really depending right now on the Fed totally getting it right. But bad events happen. And so you're just like it just dials up the risk because you don't have a Fed, or just more broadly in thinking about interest rates, that's thinking hard about, is this the best thing to do in terms of the evidence and the economic conditions? And so then you could make a really bad decision in terms of interest rates. And if that moment of financial disruption comes, you could just really botch it. And financial markets move fast. Like the Fed, there have been multiple times where they kind of got things under control quickly, like over the weekend or came in, and it didn't spiral out. Well, if you have a Fed that comes in and really botches the response, things could start spiraling out. So it's not a guarantee that bad things happen, and we don't want to over dramatize it, but it's like, why? What purpose does this serve in terms of the American people and the economy functioning to be putting this much pressure on the Fed and just like really trying to push through a political agenda on interest rates that historically has not ended well.
And the Fed's track record is it's not perfect. Clearly, they made some, or they called inflation wrong in 2021, but it wasn't we didn't get stagflation back. I mean, this is an institution we ought to be cherishing for being admired and having done stuff mostly right, and now instead you have potential criminal charges. It's just.
Well, and I think another piece of a Fed that really is trying to engage with with the data, the evidence. I mean, the Powell Fed gets a lot of criticism for not raising rates soon enough. And in 2021, as inflation's taking off. So, but they did pivot. In 2022, the Fed raised interest rates very aggressively to try and get that under control. So they were willing to shift gears. Powell has even said we could have moved sooner. You have individuals that have been willing to admit a mistake and change course because the economy says we need to change course. For as much as the Powell Fed is criticized for the inflation we saw in 21 and 22, the Powell Fed also oversaw a very rare occurrence of a soft landing. Inflation has come down, not all the way down, but it has come down a lot. The unemployment rate has risen some, but we avoided a recession. This is not typical. And I think part of that is, and the Fed is not it's not all about the Fed. The Fed does not run the economy, but it is really important to have an institution, have people at the Fed who are willing to pivot and do what is right for the economy, not kind of stick to their guns of well, I just know that we need to be doing XYZ with interest rates. So they pivoted, and when they pivoted, they moved, really forcefully. And that's they're responding because the economy was giving them signals hey, you gotta course correct here. And that kind of response that contributed to what has been despite all that's been thrown at the US economy since the pandemic, this is, we've done pretty well here. So that speaks to that ability to change course and pivot is really important, and that's something that I think would be very hard if it's all the political calculus behind it.
Gosh, actually having people in positions of responsibility who are willing to admit mistakes and change course That's a kind of an un-American idea at this point in our nation's history, but amazing thing. Well, thanks so much. Quite an amazing moment. And I not the Fed. The Fed is not unique in kind of frog moment, but this is not someplace I expected to see this kind of thing. Thanks again so much for talking to me.
Yeah. Thank you.